Well, I need to officially welcome you to our first lecture, and without further ado, we're going to get started. We are actually going to get through 2 sections today. I'm hoping to get through 2 sections tomorrow, leaving the financial statements for later in the week. By the end of the week, you will have been exposed to the entire chapter with my lecture, leaving us a few days next week to do problem work, a little bit of homework, practice tests, and then of course a week from Friday is your first exam. I'm not sure if the book described this at all, but in general, accounting is typically coined the language of business. Did it talk about that in the chapter at all? You might want to write that down. What is accounting other than this IRC that you're going to learn? It can be seen as talked about the language of business. You heard our cooperating professor talk about that. You might not all run off and be accountants. But if you're going to be a business major, accounting will definitely be part of that major. Maybe it's you being the marketing person at a business, and they're saying no to some major marketing campaign that you want to kick off because it costs too much. Well, for you to take a look at that company's financial statements, you would see that it's not in the budget, okay? Maybe you end up, I think the professor gave the example of maybe you are the treasurer on some committee, and you would have to produce financial statements and business reports. Those pieces, which we're going to talk about in the last section of this chapter, truly become the language of business. That money, those numbers speak the language or the fiscal stability of that business. What I want you to learn, and you saw this in your notes, IRC. The purpose of accounting is to identify what is or should be recorded, and then who do we tell that story to, or who do we communicate that financial story to. So we're going to get into each of them a little bit more in depth, but the purpose of accounting is to IRC, identify fiscal transactions, record them, and then go turn around and tell the story or communicate it both internally and externally, and we'll talk a little bit more about that. What you need to know with IRC, it's economic events, stuff that impacts the bottom dollar, that almighty dollar. If I sell something, that becomes an economic event and there's money exchanged. If I hire a new marketing person, the act of interviewing them isn't necessarily an economic event that would get recorded in the books. When we turn around and pay that new hire, then yes, that's an economic event. So there's a gray area of hiring someone or giving someone a tour versus having it affect that almighty dollar. This would have been a supplemental piece in the supplemental handouts that I gave you. You'd want to have access to this. You'll toggle between your own notes and my supplemental handouts. Here we see the 3 activities again, IRC. What happens when you identify stuff? Again, you're looking at economic events. Which ones truly would get recorded somewhere and then later communicated? The act of interviewing for a position is not an economic event. If you hire them and you maybe 2, 3, 4 weeks down the road pay them, then yeah, that becomes an economic event. So economic events in terms of accounting is when dollars and cents are impacted. From there, the accounting department records them. A term you'll hear us use a lot, we're going to journalize them, which we eventually post and then create financial statements out of. So we first have to stop and say, is this impacting the almighty dollar? Is this economic event affecting our books? If it is, we're going to go ahead and record it, and then we are going to create accounting reports that we're going to communicate either internally to our internal users or tell more of our story to our external users. The accounting process does include the bookkeeping side of things, which is journalizing. We are going to do everything pen and paper. You heard our cooperating professor say how important that is. If you would go work in the industry right now, are you going to be pencil pushing all day long? No, you're going to be on the computer. Everything's going to be inputted. Some large businesses have their very own system for what works for them. But you are going to, just like when you take driver's training, you guys, they don't put you in front, behind a wheel. You have to take driver's training first before they even put you in a car. You have to do the bookkeeping. You have to do the pencil paper version of all of this first before I would turn you loose on a computer system. The idea of managerial accounting pertains internally. Internal accounting is considered managerial accounting. Who? Well, absolutely the finance department, the accountants, the finance VP, okay? The people who are doing that I, the R, and the C, the identifying, recording, and communicating. I talked about marketing. Maybe marketing wants to kick out this huge multi-million-dollar marketing campaign. Do you think they have the power to just go do that? No, they're going to look at that language of business, or in other words, they're going to ask the finance department, can we afford this? HR. Should we hire people? Should we fire people? Can we afford to hire more people? Can we afford to give them a raise? Again, does it all pertain to accounting? Does it all come back to that almighty dollar? Absolutely it does. And management looks at all of this holistically. That accountant is that duck paddling underwater to make it pretty easy for the upper management to make decisions that affect all aspects of the business. Again, all of the internal people that work for the business is considered managerial accounting, whereas the external people, and we're going to identify them in a minute, that's considered financial accounting. Who are the external users? Well, one that's not even on here that I think should get added, customers. Here's the little shopping bag, okay? There's our customers. Do you think our customers will care about the financial stability of our company? Yeah, they probably don't think about it as much as some of the other external users. Let's think about this a minute. If we let people invest in our business, do you think they are going to be concerned with the financial stability of our company? Publicly traded companies, it's oftentimes one of the first things that stockholders are going to look at. They're going to go look at the financial reports, or the C part of the communicating. Because remember, if I go back a couple, we communicate both to our internal people, but we need to tell our financial story to our external people as well, because if someone's going to go invest in our business, they're going to want to see things like balance sheets, income statements, cash flow statements, owner's equity statements. So we have to communicate that story, and we have to be very honest. You read about that in the next section, that there are laws that pertain to telling our financial story. Creditors. So in other words, when we have debts hanging around and we owe them money, do you think they're going to want to take a peek at our financial records if they are public and available? If they see that we have no money, that's a problem for them. Are they directly impacted by our day-to-day business? Well, they're an external user. They've probably got their own thing going on, but what we're doing does impact them. And then, of course, I see investors here twice. That's where I really think customers play a factor too. That's it on the first section. But I'm going to flop back, and then let's look at this one more time. Who is doing a lot of the identifying and recording? Well, definitely the recording ends up being a lot in the finance department. And you know, that also pops back up here. The accountants, the finance people. They turn around and communicate the money story, now we know, to both internal and external. You might think, what is marketing? What does HR have to do with finance? It's driven by finance. Okay, it's driven by the financial health of our business. So there's internal people. What was that type of accounting? Managerial or financial? Which one? Managerial. Internal is considered managerial. Think of it as you're managing your people. You're managing the internal makeup of the business. Whereas external is the idea of financial accounting. Telling that financial story to, say, people we owe money to, investors in our business, or maybe even our customers. I'd like to continue on to our next section before I turn you loose on some end of chapter stuff. Before I do you have any questions on that first section? I see colored notes. I see extra notations. The two big takeaways, if I had to give you a quiz today, I think you'd do okay. What are the three big activities again? IRC. We identify what really needs to be recorded, and then we communicate that with internal and external users. Does HR really care what's going on with the finance world? Yeah, can we hire, can we fire, can we give people raises? Can we afford that new multi-million-dollar campaign? If I'm an external investor, I'm going to really want to know what's going on with that company before I give them money to my own money. Or if we're running around with a bunch of debt and these creditors are knocking at our door saying, I see you have no cash. How are you going to pay me? That's a big deal. So that's as simple as that is. Can we move on to the next one? Good. All of these people, both internal and external, who we're communicating this story to, want to know that it's ethically done correctly. Ethics and proper reporting, that we're not falsifying numbers or hiding numbers. Internally and externally, from a managerial and from a financial accounting perspective, assume that we're doing this with our heart and we're doing this with a clear conscience. Ethically, that this all makes sense. I'm going to read to you what this says. United States regulators and lawmakers were very concerned that the economy would suffer if investors lost confidence. Okay, are investors internal or external users? External. And if all of a sudden, as an investor, they can't trust us, they question our ethics, the economy would suffer because they would invest less. Mainly in corporate accounting, because of what has happened. You know, there's some huge cases. Did it talk about Enron in the chapter? Okay, you know, and Enron was messy, complicated, but basically at the end of the day, things were unethically being reported and funds were being hidden. Here's Enron right here. I guess I don't know a lot of the history with the others listed, but there were some large scandals not too long ago that provided a shaky investing culture, I guess. And people were getting worried, like, okay, well, if Enron, WorldCom, these folks are doing it, who else is doing all of this unethical reporting? And it affects the economy. So what Congress said, Uncle Sam said back in 2002, we're gonna make legislation here that like they can't get by with that. What you need to know, though, is that it was at the corporate level. It was at, corporations in the United States now have to follow SOX, or this act, that things need to be done ethically and fair. So what do you need to know about SOX? We could sit and read articles and we could watch YouTube videos about what SOX is. What you need to know about SOX, and if you can memorize what it stands for, great, but just SOX basically means Congress stepped in to put a kibosh on all of this unethical reporting, so that publicly traded companies in the United States had to follow certain laws to stop things like the Enron scandal. That's what you need to know about SOX. Could we get into a long, lengthy analysis of it? Absolutely. But it's just giving investors, external users, peace of mind that there's laws that go with this. And SOX is one of them. Should you know the date? Yeah, maybe. 2002. It's already going on many years old. As we look at a little bit more about ethics in financial reporting, there's 3 points there that the chapter made. Recognize an ethical situation and the ethical issues. And it becomes personal ethics versus professional ethics, and I think the two should go hand in hand, but at a corporate level that they're expected that they act professionally. They're not hiding numbers or swindling numbers, different things like that. Identify and analyze the principal elements in the situation. So who would be harmed if I start laundering money or unethically doing this? And who are the internal and external stakeholders here that would have harm if I would push through and act unethically? And then finally, identify alternatives and weigh the impact of the stakeholders. Basically, it's just posing 3 questions to see if you're ethically behaving from a professional level. Just remember, SOX is a congressional act that keeps people accountable. We get into some principles here, okay? The idea of a principle, and I'm not talking Mr. Kehoe, our principal, but the idea of a principle is a fundamental truth. So you might want to write that down somewhere. Principles in general are fundamental truths. Stuff that just in your very core is what you live by and go by. The big one that you will hear time and time again is GAAP. Generally accepted accounting principles. Just like there are teacher ethics. That's what they call them. They don't call them principles, but they call them teacher ethics. The Minnesota Code of Teachers Ethics. The National Code of Teachers Ethics. There are things I should do and not do as a teacher. And you just kind of go with it. It's just how I approach day-to-day working with learners like yourselves. Well, in the accounting profession, they have the same thing. They just call it GAAP, Generally Accepted Accounting Principles. And it's kind of like that big brother approach. They're watching you, okay? Like it's they, meaning there's probably a board. There's probably a national Generally Accepted Accounting Principles board. I guess we could look that up too, but let's just go with the simplicity of the book. What they've done is attempt to develop a set of standards that are basically universal in the accounting profession. So what do you need to know about GAAP? It has the word principle in it, so it's a fundamental truth, or a set of standards that are basically universally accepted in the accounting profession. We could look them up. But there's things that accountants should and shouldn't do, just like there's things teachers should and shouldn't do, because it's just part of the ethics or the set of standards within our profession. Should you need to know what GAAP stands for on the test? Absolutely. Please know what the acronym GAAP stands for. Generally Accepted Accounting Principles, or in more simple terms, the fundamental truth, the set of standards that people in the accounting profession follow, much like the set of standards or ethics that teachers follow. Here's a little bit more about GAAP. Again, a set of rules or practices. What I like there is that they have substantial authoritative support. So in other words, if there's an accountant acting out of line or acting unprofessional or acting with cloudy ethics, the GAAP board will come after them. Okay. Within, and I shouldn't even say within, but beyond GAAP, there's 3 more standard setting bodies. So as if GAP's not enough, there's the SEC, there's the FASB, and then the international. Okay, so let's just take a look. I would know that there are even more, I don't even want to call them governing bodies, but they're more like standard setting. Like, as if GAAP doesn't rule enough, there's the SEC, and I'm not talking the college SEC for sports, okay, but the Securities and Exchange Commission, the Financial Accounting Standards Board, and those are both domestic here in the United States. And then, of course, international is more of a worldwide standard setting board. And again, it's not a governing thing like, like Congress, or it's not the government stepping in. It's more of just these standard setting bodies. We have GAAP, we have the SEC and FASB, and then on the international level, we have the International Accounting Standards Board. So in other words, can you tell that they take ethics pretty seriously? I like the international note. You likely saw this in your book, but over 100 countries use the IFRS, for example. All companies in the European Union follow the international standards. The differences between US and international standards really are not that significant. It's just there's a lot of eyes watching that accountants are reporting, or IRC, identifying, recording, and communicating ethically. Back to principles. Again, those fundamental truths. What are principles? Fundamental truths. It's just kind of ethically how you approach. And there's, I think, 4 that the book talks about. I want to give you some good examples of each. The first of the 4, the historical cost principle, or in other words, the cost principle, simply dictates that companies record the assets at what they bought them for. If they go buy a new $50,000 truck for their fleet of vehicles, ethically, they best list that for what they paid for it, or what the cost to acquire that asset. Versus the fair value principle states that assets and liabilities should be reported at their fair value, the price received to sell an asset or settle a liability. We'll get into more assets and liabilities tomorrow. You know a little bit about the terminology because you read the whole book, or read the whole chapter over the weekend, but this is saying, like, what are they valued at when it's time to sell? Historical is maybe more when they buy the asset. Fair value is when they go to sell the asset. It's basically saying if you're going to go sell that $50,000 vehicle 10 years later when it's by no means worth $50,000 anymore, you better be selling it at what it's valued at today instead of $100,000. And you might say, well, duh, that only makes sense. Well, again, these principles are these fundamental truths that you're not going to approach this unethically. A $50,000 vehicle 10 years later is not worth $50,000. That's called depreciation. It's a whole other chapter. A few more. Now, these are assumptions. In other words, we can assume. The monetary unit assumption and the economic entity assumption. Let's identify what those mean. The monetary unit assumption requires that companies include in their accounting records, so the IRC, the R part, what we're recording, only the transaction data that can be expressed in money. So the monetary unit assumption, we're assuming we're only listing stuff that has a dollar amount attached to it. And I want you to write the example, good versus bad dentist. If you go to a dentist office and there's one dentist that might be good and the other dentist that might be bad, the work that they performed is not impacted on if they're a good or bad dentist. It's the work they performed. If they put in a filling, the filling is that dollar amount. Okay? We're only expressing things in terms of that has money attached to them. We're assuming that, hence the name assumption. The economic entity assumption requires that activities of the entity be kept separate and distinct from that of its owner and all economic entities. To put it simply, the dentist has a personal life too. And that doesn't impact the business. Does that make sense? Just like me as the person versus me as the Junk by Jenny owner, I have to keep things separate. Okay? If it's a, even at school here, like I have to keep my personal funds separate than what happens here at school. Okay? Does that make sense? So it's just putting that business owner kind of on an island versus no matter what's happening personally. Is it okay for me to take some paper home with me, or that dentist to take paper home? No, because that is an infringement of that economic entity assumption. We're assuming they're not stealing from the business. Well, they're the owner. They can do whatever they want. Well, no, it's a business entity versus their own personal entity. It does get into a little bit of types of ownership. We are going to focus on sole proprietorships and partnerships. We will not get into corporate accounting in this class. Who owns a corporation? Shareholders or people who invest in the business. Okay, and that complicates an accounting cycle. Okay, you are going to see start to finish a sole proprietorship and a partnership from the perspective of a full accounting cycle. How to form it and how to close the books and everything in between. Proprietorship is generally one person. It's often more of a service business or a small business. And in this case, the owner gets to celebrate profits or suffers any losses and is personally liable for any debts. So in other words, if the business can't pay the debts, the person has to pay the debts. If Junk by Jenny cannot handle her business debts, those creditors are going to come after Jenny Mars, the person. We get into like types of risk that partners take, and that's later in the book. Okay. What you need to know though about a proprietorship, it's typically one person. They smile in the good times, they cry in the bad times, and if the business can't handle it, the creditors will pounce on the person if the business can handle it. Partnerships are two or more people. I think the word partner assumes it's two, but it can be multiple partners, two or more. Okay, more of the retail and more retail there, but and I don't know. I argue these 2 points. I mean, I could go, Be inspired is, I can't speak for Bonnie Kentop for sure, but she's likely a sole proprietor. Okay, well she's a retail store, offers some services as well. So use these loosely. Service versus retail. They're selling stuff or they're selling services. We'll get more into that. We'll get into types of partnerships, but sometimes a partner can be a silent partner. Sometimes a partner can be in a bubble where you can't touch them. A general versus limited partner, we'll get into that in chapter, I think, 12. Just know that there's many types of partnerships. Some protect partners more than others. Corporations, although we're not going to cover that in this class, it's where ownership is divided among shareholders. It becomes its own legal entity. Like, I'm not going to go sue the owner of Nike if I don't like how my shoes turned out, because there isn't one owner of Nike. It's equally divided among its shareholders. Nike becomes not even, it's its own legal entity, and there's not even people to go attack. Okay, there's about 10 minutes. I'm going to get you started on this. This is your homework for the evening. I refer to anything we do end of chapter as EOC, end of chapter, okay? You're going to have some homework for the 2 sections that we just covered. Remember, there's 5 sections for this chapter. You've read, you've taken notes on all of them. I have now lectured on section 1 and section 2. A lot of times we'll pause and do end of chapter work instead of waiting to do it all at the end. I like to embed it and do the stuff while it's fresh. You will do questions 1 through 10. You can find them in your book. Here's where you'd want to grab your book. I will help you find them as well. Questions 1 through 10 start on page 33 and dip over to page 34. I think I looked, no, sorry, I said that wrong. 32 and 33. My apologies. So for example, the first one reads, accounting is ingrained in our society and it's vital to our economic system. Do you agree or disagree? You should agree. Okay, and why? Number 2, identify and describe the steps in accounting. Identify I, identify R, identify C. And then there's number 3, number 4, number 5, number 6, all the way over through 10. Where will you write these? Well, eventually you're going to get workbook pages, but the workbook pages don't have them, so I didn't give those to you today. You're just going to write them on a notebook paper. Okay, and typically students will put all their end of chapter work right after their notes or my supplemental handouts. So you're going to do questions 1 through 10 on page 32 and 33. Then you're going to do exercise 1-1 and exercise 1-2. Look on page 33. Do you see brief exercises? Not those. Keep going. Keep going. Do you see on page 35 that big do it chunk? Not that. Do you see the exercises at the bottom? Exercise 1, the Zimmerman Company performs the following accounting tasks. If you go over to page 36, then you also see 1-2 as well. So on page 35 and 36, you'll see those. So you've read it, I've talked about it, now put it into practice. Okay? What we'll do is we'll go through these answers right when you arrive tomorrow morning. I'm expecting you do them. Would this be another thing that I grade toward your 100 points toward the test? No, because I graded your notes today. Now, you know then that I'm not going to grade anything more for the test, but would it be wise of you to do this? Yes. The questions are pretty easy. Let's take a look at the exercises. So Zimmerman Company performs the following accounting tasks. Analyzes, classifies, explains. Okay, then do you see it goes on to the next page? The directions actually are following. Categorize the accounting tasks either as an I, an R, or a C. Then for 1-2, it lists people and it wants you to say, are they internal or external users? Okay, cool. So that concludes our first lecture. That also concludes your homework for the evening. I think if you're fast, you could maybe even get this done before you leave, or real close. Thank you.